I want to be able to people to ask questions and really learn more about our donor advised fund and how we work with not only the donors, but also with outside individuals, and then how our fund operates. So some of it will be repeat and some of it will be new information. I just want to quick note, the calculations in this presentation, as well as comments made, are for illustration purposes only. And please do not take them as legal, accounting, or other professional advice. So donor advised fund, I want to start at the beginning and we'll go from there. A donor advised fund, it's a charitable savings account. It can be funded with stock, appreciated assets, like real estate, or other type of appreciated assets, and other non-assets, anything that we can sell, we could talk about putting into a donor advised fund. Contributions to a donor advised fund are invested and they remain into the fund until the donor decides what charity to send them or to make the grant to. It grows and you keep the gains, which is different from some of the other donor advised funds out there. Anything that is gained in the account, you get to keep and you get to grant out. We don't take that at the end of the year or make you grant it at the end of the year as well. Some interesting information, which I noted on last time about donor advised funds. There's 121 plus $1 billion in donor advised funds across America, and it's one of the highest growing ways to do philanthropy. It's record numbers, and every year we see it continuing to go up. In 2018, grants from charities for donor advised funds totaled $23.42 billion, and contributions to donor advised funds were $37.12 billion. And the largest charitable fund is not even a charity. It's Fidelity. And we'll get that going through at the end. We'll talk about if you had $1 million and it was in a charitable donor advised fund at Fidelity, what you'd be paying and what you're missing out on as opposed to if you had a charity like Jewish National Fund. How a donor advised fund works. The donor creates the fund, either with Jewish National Fund or with Jewish National Fund, we hope. Then, can everybody hear me? I see there's a chat that people are having trouble hearing. Can everybody hear me?
Yeah, go ahead.
All right, let Efrat or Ken know if we can't. Thank you. You create it and you fund it with the assets we talked about. The donor then receives a tax deduction in the year in which the gift is made, and you get it for the full value of what you put into the account, and then distributions can be made afterwards. Never have to spend it every year. You never have to deplete the account down to zero every year. With us, if you have it for a couple of years and you haven't spent anything, we may come to you and say, hey, you haven't made a grant yet. Maybe you should consider to start making one. And you can grant to any charity that is a 501c3 charity. Donor advised funds, I have an asterisk next to it, but you can use it to pay pledges. It's a gray area, so that's something that we can talk about. It is something that was written about where, and Matt can allude to this a little more, as long as you don't say it's going to pay a pledge, you are able to use them for pledges. The money does not have to be distributed in any given year. You get the charitable deduction in the year it's established. You will not get it when you go to make the grant unless you put more money into the donor advised fund. One of the nice things, which we're really focusing on, is intergenerational. And you can appoint a successor trustee, which you can be able to have it carry on for years to come and create the dialogue with your family as to how to give and how to be able to make those grants after the generation that may have started the fund has gone. So, we're working on a lot of intergenerational. So grandma may be very passionate about Israel and she wants to continue that down to her grandkids and great grandkids. And this is a great way to be able to sit down when we can have Thanksgiving dinner together, when we can have Passover together, and grandma or grandpa can share those stories as to why it's important to them and why they give, in hopes to have it as an effort across the board. And again, you can fund it with cash or appreciated assets at any time, and you can add to it as you wish. I want to get into why one of the reasons why a donor advised fund has become such a hot topic in philanthropy, and that was the 2017 Tax Act and Jobs Act, where the standard deduction became much higher. In the past, a standard deduction was $13,000 for joint and surviving spouses, $6,500 for single, and $9,550 for head of household. In 2000, with the Act of 2017, it jumped up to $24,400 for joint, $12,000 for single, and $18,000 for head of household. And with those, there was also changes in itemized deductions with the SALT limit, which is the state and local tax limits, for $10,000, where you can claim property taxes, local sales, income. And your medical expenses are 7.5% of your adjusted gross income thereafter. Mortgage deductions on home mortgage was limited to acquisitions of $750,000. And the reason that's important is because of the idea of bunching. So instead of people stopping to make gifts altogether to not hit that standard deduction, you can bunch, and we'll go through some examples in a minute, where bunching the examples together is you can still give the same you give over a 2-year time period or a 4-year time period. You just maybe take that standard deduction 1 year and then you itemize the next year. You still give the same amount to charity. It's just about the timing as to when you do it. And it's also good for the bunching if you're expecting to have something big happen, investments, sale of stock, that you wouldn't normally have in other years when you can take advantage of that tax deduction. Excuse me. So we're going to get into the bunching, and we'll take a look here. Whereas you have your medical expenses, we'll take a look at the top, where the adjusted gross income of $200,000. And this is with bunching. This is without the bunching at the bottom. So you've got your $200,000 adjusted gross income. You've got your $10,000 medical, your threshold of $20,000. And then you're not really the deductible here. There's nothing there. You move down to the SALT. You've got the $3,000 in taxes there. And then your contributions, you'll see here in year 19 and 21, you've got contributions of $40,000. So you're bunching those together. You'll take the standard deduction in 2 of the years, but if you look in here in 2021, you're actually higher than that standard deduction. So because instead of spreading it out over the 4 years, you put it in 19 and 21, you're able to take those standard deductions, which is higher, which is tax savings here at the 30% tax bracket. There's your charitable deduction. Whereas if you don't, and you just bunch without bunching every year, you're not able to really take advantage of that extra tax benefit. So let me stop there. Does anybody have any questions on the bunching? Scroll through anything? All right, we'll keep going.
Do have one feedback comment, Bill, if you wouldn't mind speaking a little bit slower.
We'll definitely do that. My apologies. I want to talk about the comparisons of a donor advised fund versus a public charity foundation or family foundation. So one of the things we've come to see is a lot of families are taking their family foundations and starting to give to donor advised funds as part of their required 5% a year, or as opposed to opening a family foundation, they are just giving to a donor advised fund. And some of the reasons are, with the donor advised fund, there are no setup fees. We don't charge you anything to upfront to set up, where with a foundation, you do have setup fees for legal, accounting, and filing fees. With a donor advised fund, you have no annual distribution requirements. With a foundation, you have to give away 5% a year. Regardless of what's going on, you have to give away that 5% a year, or you're taxed on that. Again, no excess tax with a donor advised fund, but there is on a foundation if you don't give away that money. With donor advised funds, everything is anonymous. Everything is done. It comes from your donor advised fund. It's all done. There's no 990s, which there are with private foundations, which is the IRS filing. Everything is done confidentially with a donor advised fund. So as a fundraiser, somebody can't look and say, well, the Gilman Family Foundation gave $3 million to Jewish National Fund last year. I'm over at this charity. Let's go talk to them because we know they have money to give. With the donor advice fund, nobody can see what's out there. There are no public 990s. You have support in making grants. You have the time to set up is very short. It's very simple to set up a donor advice fund. And the administration is pooled in terms of everything is put together in one. So it's not like with a private foundation where you're having to pay lots of extra fees to run it. Everything is pooled into one. So it's administered as one donor advice fund. When you have, even though they're separate, you have your own separate accounts. Some of the income deductions with a donor advised fund, you can give up to 60% of your adjusted gross income for cash. And appreciated public traded stock is 30% of adjusted gross income. And then long-term real estate is also up to 30% of adjusted gross income in 1 year that you can deduct. This is what our portal looks like. It's very easy to navigate. You have your online account, username and password. Everything's there. It gives you an up-to-date as to what your balance is, the grants that you've made, how you're allocated, which I'll get to in a second because you can pick from different funds. And again, you can make a grant to any U.S. charity as long as it is a 501c3. With Jewish National Fund, we also won't make a gift to a charity that's antithetical to what we believe in. So, Matt uses, we won't send a Jewish National Fund check to friends of the PLO, although I think anyone that is on this call or gives to Jewish National Fund wouldn't want that gift to go there anyways. We have 5 different investment portfolios that you can choose from, and you're able to mix and match and change them. And they are managed by a professional money manager at JP Morgan. One of the things that really sets Jewish National Fund's donor advice fund apart than some other charities or the Fidelity and Schwab is you actually have access to be able to know what the manager is doing, the financial manager is doing. And in certain cases, we can even connect you to him as well. And here are just the different investment portfolios. You can go anywhere from money market all the way to aggressive. And then really what sets us apart, and this is where I kind of want the conversation to go and I want the questions to be asked is, you're the family of power of intergenerational programming. So we have donors that will sit down and we can help facilitate what was important to the first generation and the second generation, because not everybody agrees, but we can be there to help give that guidance and give that wisdom that our planned giving staff may have to be able to help facilitate smooth family giving. You're more than just an account number. And I'll use an example. Last Thursday, a newer donor advised fund out of the Midwest called, and she was having trouble making a gift to a Hillel. They're an approved 501c3. She was having some trouble with the back end. She called. I said, don't worry, we'll take care of it. I called Dorada, who is in New York, Dorada Economy, and she helps administer the back end of the donor advised fund. She was able to get in there, make the grant, and take care of everything for this donor, as opposed to her having to call and wait on hold, because we know who our donors are. We know who you are. You know who we are, and you can call anytime. And that's a huge difference as opposed to just being a number at the big institution. All the gains stay in your account until you grant them out. There's organizations where if you have $700 of this gain in your account, you either need to grant that to an organization or they take that back into theirs at the end of the year. We don't do that. Everything stays in your account. And there are no grant requirements for the year. You can make as many or as little as you would like. Like I said, after a couple of years, if you haven't made any, we may kind of nudge you a little bit and say, what's going on? But for the most part, you can do it as you wish. And the fees, they're not going to help another organization that may be against Israel. So you don't know, we don't know what some of these other organizations are doing, but you know that when you have a donor advised fund, when our donors have one with Jewish National Fund, it's, where the fees are going. You have access to money managers and are below industry average administrative fees. So for us, anything below $1 million, our administrative fees are 25 basis points. If you go to, I'll give an example. I was talking to a colleague the other day, and she tells a story of somebody that has $1 million donor advice fund with one of the big institutions. Well, their administrative fees are $10,000 a year, which are much higher than what ours equate to. And you could take that $10,000 extra that their administrative fees are coming out of, and you can give that to Kaluza. You can have that go to a student at Alexander Muss. So you really know that you're not just supporting the organization that may be a public organization that just has a charitable arm, but you're really helping something that you're passionate about. Again, and that we're not supporting a large organization. And then really the successor trustee planning. It's so important to be able to know that when the person who has the DAF passes away, that they can go to the next generation, and you can set those up ahead of time, and we will definitely help you so that you can always continue on the giving.